Hi, Gary and Kevin here from Chicago, and you know it's spring moving into summer, and it's kind of what's going on with the business cycle. Now, you may recall the business cycle is that cycle we've had over many years where we start off after a recession and move up from buying inventory and housing prices move up, and then consumers start spending, and then it kind of cycles back down. So another analogy would be we're in the fourth or fifth inning of a baseball game. Now, where's the proof for all of that macroeconomically? Well, one of the leading economic indicators that we look at, or actually the Consumer Board of Economic Indicators, basically is factory work orders, looks at building permits, durable goods orders, first-time jobless claims, and the like. That's been growing at 5% year over year, which is an indication of a growing economy. Next, we have a normal yield curve. What is that? Well, it's a yield curve is, if we look here, this is long-term yields, 30-year bonds, and over here is short-term. Normally, you're going to see real low rates here, right now at 0.25%, going on out right now for 30-year rates at 3%, and that's what it currently looks like. It's normalized. That means the economy is doing well. Next area is consumer. The consumer's been deleveraging. You notice three charts here, and on those charts it's showing $1 trillion of debt has been basically paid off, and the consumer looks like they're ready to start spending a little bit more going forward. We'll see here in the next few months if that in fact takes place. And finally, labor demand. There's two charts here if you look at from the Bureau of Labor Statistics, and one is the manpower employment outlook, and that's showing it move up over the last 4 or 5 years, and then you can see the available labor supply, and you can see that moving down over the last 4 or 5 years, both of those being very positive outlooks on where we are at this business cycle. So, you know, Kevin, we're, maybe almost halfway through the business cycle, but, we buy bonds for two reasons. One, we want income, and the second reason, we kind of want ballast, against the stock market. But interest rates seem to have gone in the opposite direction everybody thought. So what's going on with that?
Well, interest rates are the price of money, right? So if there's economics 101, if there's strong demand, for example, if the wheat crop, there's not a lot of rain and there's not a lot of wheat out there and there's over demand vis-a-vis supply, prices will go up, right? So there's a lot of supply out there because our government's printing money. They're buying back bonds through as we talked about in previous market updates. European governments are doing the same thing to stimulate their economies to keep interest rates low. So there's a lot of supply out there keeping interest rates low. We don't have a lot of velocity of money in the system. We don't have a lot of true economic activity. So while there's growth, it's tepid, it's slow, and that's the thing that's concerning most folks. When it comes to the stock market. But everybody keeps thinking, oh, this is inflationary. Rates have to go up. They have to go up. They have to go up. And meanwhile, they keep going down. So supply is up, demand is not commensurate with it. Right. You also have European nations doing the same thing our government's doing, and you look at European yields vis-a-vis the United States yields, 10-year Treasury versus comparable other government bonds, and our rates are higher. So you might say that the market is saying that they're going to come lower. Another thing that might have happened, which some of the things we read in the last couple of months, where there are a lot of people, institutional hedge funds, that were betting that rates were going to go up, and were actually shorting bonds.
Right.
And with rates going the other direction, they had to buy the bonds back to cover their short positions, which caused an additional rally. I mean, the long bond's up over 10% year to date.
Right.
So whether that's sustainable or not remains to be seen. But we tend to stay away from fighting the Fed, or else, and as well as hedge funds. Bonds, if you're buying them in your portfolio, intermediate bonds, we've been waiting for interest rates to go up our entire careers, it seems like. Intermediate bonds consistently, while they might underperform from year to year, they normally beat cash because you're getting a little bit yield because that rising yield curve. If you buy 2 to 3, you're getting a little bit more than cash. And if interest rates go up, you always have some bonds maturing, and you roll out the yield curve and you buy that higher coupon bond at that time.
Right.
So the story is the same. It's just that you're getting a lower yield from that portion of your portfolio. And if you want it to be that ballast, and if you want it to be safe, that's the price of poker, is a lower yield.
Right. Yeah. And I want to switch gears here to the stock market. We had a great year last year. The market, the S&P 500 was up 32%, and But the emerging markets, they were down a couple of percentage points. It was a really tale of two sides of the marketplace. And I think we all looked at the beginning of the year of saying, "Gee, it doesn't look like we're going to get much out of this year." A lot of the prognosticators thought we'd get 5 to 7% growth. We're sitting now at market highs, up a few percentage points. But some interesting stuff's been going on, Kevin. I'd like you to talk about this. One thing. The average S&P stock, as at the end of April, was down 12.5%, and small and mid-cap stocks were down even more than that. And the momentum stocks, like
Twitter,
Facebook, Twitter, Tesla, Netflix, biotech, these were down on average 20%. So here you got the stock market, up a couple percentage points, but you've got all these stocks down. What's going on with that?
And you also have, maybe 4% of stocks were reaching new highs when the market was reaching its most recent new high. So the market is cap weighted, meaning the larger size companies have a bigger weight in the overall index than average stock. And small cap was up big last year. Biotech was up. Certainly the high tech growth was up. Well, obviously things that go up more have more tendency to come down a little bit faster. You're not necessarily seeing money exit the market. It's going from certain areas that are going down that have had good runs last year and going into other perhaps bond proxies. REITs are up. Consumer staples are up. Utilities, energy, transports is still at highs.
Right.
So it's not necessarily indicative of a falling apart market. It's kind of recycling. And part of that's relating back to the bond story. People trying to find yield. They got to invest somewhere. So you've got pockets of risk here, and then maybe your short-term money. So you're kind of in two baskets instead of spread across the whole asset spectrum.
Right.
So it's not healthy for a market when you don't have breadth, where you don't have more stocks reaching new highs. But it's not a negative per se of cataclysm as long as the money is recycling, going to other areas.
Right.
This market's been under-owned since 2008. People have been fearful for so long. So I think that's a positive in a way, that we're not certainly at the euphoric levels that you normally see a big decline in the markets.
Yeah, and the Michigan confidence indicator out there basically saying it's still not back to average. It's still below normal. So people kind of been almost forcing themselves into the marketplace.
And consumer sentiment normally is going to kind of impact how much people are willing to pay for earnings. So while our PE multiples are not undervalued, they're not necessarily overvalued like they would have been in 2000, 2007. Some people are saying, oh, there's not real earnings, PE earnings are too high. Well, the sentiment and the fact there's no other place to go.
Yeah.
Right? But then with, again, the other comment we made earlier is that you still don't have that euphoria, you still don't have that, oh yeah, stocks. So the stock market's been kind of holding up even though it has been underowned.
Right, yeah, that is. And, we have, Janet Yellen now is a new Fed chairwoman, and actually, Kevin and I were reading an article recently where the Bernanke now is out there telling what he really thinks, and talking about these interest rates. He's saying 2, 3, 4 years we could have low interest rates because the way we have to recover from this great recession that takes place. So the bond tapering is continuing. We'll see if it ends or keeps going until I believe October, where it'll be over. And we'll have to see what happens. So we hope you have a really great summer, and we'll be back at you sometime around August or so. Take care.